This is Ralph Sass, and this is Accounting 211, the lecture for Chapter 5 on the accounting, finishing up the accounting cycle. And what we're going to work on here is closing entries and preparing financial statements. Public companies are required to prepare financial statements. Usually they're audited by the CPAs of the company's outside independent auditors. They're certified public accountants who usually come in the spring of the year, whatever, and take a look at the records to make sure they accurately and fairly reflect what's going on in the company. From the last chapter, we'll recall that we started with the adjusted trial balance. We've just completed all the adjusting entries. All the items in red are the items that have been adjusted in this particular case. The blue are those that have not been had any adjustments or any changes. And so let's go ahead and, well, one other quick point. These items up here are all going to show up on the balance sheet. These items down here are all going to show up on the income statement, and dividends is just going to get closed to the balance sheet. So that's kind of where these items are going. The first item that you need to complete is the income statement. Notice that the heading is that the name of the company, what it is, in this case the income statement, and the period of time incorporated, which in this case is for the year ended. Revenues are at the top, then they subtracted all their expenses, including their income tax expense to get to net income. The income statement must be completed first. The reason why it must be completed first is I need that net income number of $39,942 in this case, because that is then going to go onto my statement of retained earnings. So the first thing to do is to complete the income statement. A couple of quick notes. Wherever you see a single line, that's where they're running some subtotals. And once again, at the very bottom, you'll see that there are double lines, meaning that is the end. Now what's going to happen is I'm going to take that $39,942, and that's going to show up in my statement of retained earnings. Statement of retained earnings are increased by any profits of the company, and they're decreased by dividends and any losses. Okay, so taking a look, what does our statement of retained earnings looks like? Once again, notice the heading. Okay, name of the company, what it is, statement of retained earnings, and in this particular case for the year ended. Notice they started with zero income, or zero, I should say, retained earnings. They made $39,942 during the year, okay, which gives them a subtotal of that $39,942. They subtracted the dividends of $14,000, which gives them a retained earnings at $25,942. The reason why I have to complete this statement second is I need that $25,942. I need that number because that is now going to go onto my balance sheet right down there, up right there. Okay, so once again, notice my heading, name of the company, what it is, balance sheet, particular dates. Assets, notice I don't have assets on the left, liabilities and owner's equity on the right in this particular case. This is kind of a single column. Notice I have the assets at the top and then liabilities, owner's equity at the bottom. Very standard way to do it. Okay. Notice there's my total assets, 126,192. Notice I have two lines underneath it designating that I am done. Notice, thank God, it equals my liabilities plus my owner's equity at 126,192 there at the bottom. And once again, notice there's two double lines to show that it is done. Bottom line, what do I have to complete first? The income statement. Why? Because I need that net income number for my statement of retained earnings. What statement do I have to complete second? I have to complete the statement of retained earnings. Why? Because I need that number to go into my balance sheet. And then finally, I'll complete my balance sheet because I have the information I need. Okay, this is the articulation between the three statements. It shows how they're related. And notice, just like I said, you need the income statement first, so you give that net income, which then goes into our statement of retained earnings, which then goes onto our balance sheet. The next important item to put together are the notes to the financial statements. We're not going to worry about notes for purposes of this class, but they are a critical part. Things that you have to disclose is any lawsuits pending. Okay, most companies have just a general comment that say, hey, we're involved in numerous lawsuits. We don't expect any of them to be material. We'll talk about a little bit of lawsuits when we get to chapter 10 and what do I or don't I need to include on my balance sheet for liabilities for those items. If I'm going to close a plant in the future, what have you, I need to disclose that. If the government's investigating me, I need to disclose that. Significant events that occur after the balance sheet date. Give you an example. Suppose I completed the balance sheet on December 31st and on January 3rd the building burns down. On December 31st, did I still have the building? Was it on my balance sheet? Was it appropriate? The answer is yes. But is there something that's happened that ought to cause somebody to think that balance sheet no longer accurately reflects the status or of my business? And the answer is yes. Why? Because that building, which was perhaps a big asset, burned down. Now keep in mind, I may have insurance on it and what have you, but I ought to disclose that. And where would that be disclosed? That would be disclosed in the notes. Okay. And the last two items here that need to be disclosed: specific customers, okay, that are a large portion of the business. A couple of years ago, AC Delco was the main supplier for General Motors for like spark plugs and stuff like that. And at the time, they had a note in their financial statements that said, "Hey, we sell a ton of stuff to General Motors. If General Motors decides not to buy our spark plugs, we've lost a lot of our sales and a huge customer." Only makes sense to make those types of disclosures in the notes, and the answer is yes. Okay. And finally, you would disclose any unusual transactions, what have you, that might have occurred. What we need to do now is to close the temporary accounts. Temporary accounts are the income statement accounts, revenue and expenses, and the dividend account. So basically, we're going to close all the income statement accounts and the dividend account. Balance sheet accounts are what we call permanent accounts. They are never closed. Okay. Once we have those, they're going to continue to be around. So the first thing we do is close the revenue, then we close expenses, then we close dividends. Then we close the income summary, and then finally we close the dividend account. So when we're looking at the accounts that need to be closed, they're all those at the bottom of our adjusted trial balance. They're the dividends plus the revenue and the expense accounts. First thing to do is to close the revenue accounts, and we would list all the revenue accounts. We would debit them. The reason is they typically have credit balances, and by debiting them, we're going to take their value down to zero. The reason why we close these accounts is the same reason why you have your account closed every year wherever you're working. If you take a look at your paycheck stub from the last week of work, it'll show that you worked, this year and you made 10 grand or 50 grand or whatever that number was. And then you look at the first statement in January and they wiped out all those numbers, and now you're back down to, $500 or $1,000 or whatever that number is. The reason why that occurs is because they closed your account. Okay, they closed your income account for the year so they could report that to the IRS, what have you, and kind of start fresh. That is the same reason why we're going to close the revenue and expense accounts. So we close the revenue accounts. Revenue accounts typically have credit balances, so we debit them to close them, and we credit our income summary account. An income summary account is a new account. It is a very temporary account. It's only going to be open for, I always argue, a couple of minutes while we get all of our revenue in there, all of our expenses in there, and then we're going to close that out and we're not going to use it again for another year. So it's an account. We're going to use it very short period of time, and then it's going to disappear for the rest of the year on us. So notice what we did. When we closed the revenue accounts, in this particular case, these accounts all went to zero, and it all showed up down here in the income summary. Then what we're going to do is close all the expense accounts. Since expense accounts typically have debit balances, we're going to credit them. And once again, these balances now will be 0 and 0 and 0. So all my expense accounts go to 0. Where does it all show up? It all shows up in the income summary. If we have net income, our income summary will show a credit balance. If we have a loss, it will show a debit balance. So whether we have an income or a loss, it's really irrelevant. We close the revenue accounts and the expense accounts in the same way. The only difference will be is, does that income summary have a debit balance or a credit balance? If it has a credit balance like this one does, it shows that we had net income for the year. What we then need to do is close the income summary. Since it has a credit balance, what do we need to do? We need to debit income summary for the $39,942. That'll turn that balance on that income summary account to 0, and our credit is to retained earnings, because that's where we go ahead and close our revenue and expenses to retained earnings. And notice when we do that, the income summary has a balance of 0. And like I said, that income summary account is typically open for a day or two, maybe a couple of minutes, maybe a couple of hours. It's just kind of a temporary spot for us to hold everything while we're making sure everything's cleared out. So that $39,000 of income goes into our retained earnings. Note if we had a loss, instead of being a credit to retained earnings, it would have shown over here as a debit for retained earnings. Now we need to close the dividend account. To close the dividend account, dividends typically have a debit balance, so we need to credit dividends. So we credit dividends, we debit retained earnings. Since we're debiting retained earnings, and retained earnings is an equity account, a debit pushes it down, so it makes sense that we took money out of the company in the form of dividends. So the dividend account is going to go ahead and reduce retained earnings. And when I do that, notice my balance in my retained earnings account is the $25,942, which is exactly the number that I had put on my balance sheet earlier. Now I can go ahead and put together an after closing trial balance. Once again, I put my debits in a column, I put my credits in a column, and God willing, once again, they're all going to equal at 130,000, and all is good, which means, once again, it doesn't tell me I did everything right, but it at least tells me my debits and credits are equal. There are two things we can do for evaluating profitability. Ratios are always very helpful. There's two on here that we really like. One is the current ratio, and that measures current assets divided by current liabilities. Basically, what that's doing is putting the amount in your checkbook and the amount you expect to get in your checkbook in the near future and dividing it by the bills you have sitting on your desk. Basically, it's a measure of, do you have enough cash to pay your current bills? Generally speaking, what companies look for is a number over 2. Okay, and it's one of those items that can be addressed to some extent with window dressing, which we talked about in the last chapters. The other one that we also like to talk about pretty oftenly is our return on equity, which is net income divided by average stockholders' equity. Average stockholders' equity is the beginning stockholders' equity plus the ending stockholders' equity divided by 2. And it gives us an idea of how profitable you are, how much of a return you're earning on the money you've invested in the business. General rule, you probably want to see at least 10% these days, possibly up to 20%. Okay, so those are the numbers you're looking for, return on equity. Companies prepare interim financial statements. Financial statements are always prepared quarterly. They're always prepared annually. If you're a small business, do you have to do it quarterly? And the answer is no, but is it a good idea? And the answer is yes, to see how well you're doing. Most big companies also do them monthly. Okay, so most big companies will do them monthly. When they generally only close accounts on an annual basis. In order to do monthly or quarterly numbers, what they do is they look at the number at the end of the prior month, they look at the number at the end of this month, and whatever that difference is, that's how much revenue or expense or whatever is attributable to this particular month. So do they close accounts monthly? No. Do they close them quarterly? No. When do they close accounts? Annually. But you can still figure out and create monthly and quarterly income statements and financial statements, and they are very useful. Quick note, you need to disclose any facts. We talked about the notes to the financial statements. I guess my point here is disclose anything that's material, and when in doubt, ask, because you don't want to end up with your behind in jail because you didn't disclose something that you should have. So it's always best to disclose what needs to be disclosed, and to do that, make sure you make the appropriate disclosures. The last item, and this is in the supplemental topics, is a worksheet. You will need to create one of these for your project. And just so we kind of take a look at what's going on here, let me find my, there it is. I am losing my, there. Sorry about that. Starting off, those are my trial balance. DR is my debits and credits. And once again, notice they're equal down here at the bottom. Then what I've done is I've put my adjusting entries, and this gives you a handy one-page sheet to see exactly what's going on and what's going on with all the accounts. A couple of things to note. They marked that that's coming from transaction H. Now I don't know what that is, but that's fine. But notice then also they've got down here transaction H. So if there's any questions about that, I can see really quickly and easily which transactions go with which ones. Notice what they did. They took the 6,500, added the 750 as a debit, and got 7,250. Notice for the shop supplies, $1,800 debit plus the $600 credit means that it only now has a balance of 1,200 bucks. Okay, because 1,800 minus 600 is 1,200. So if they're both debits or they're both credits, they're going to add to one another. If they're debits, credits, they're going to offset. Okay, which makes sense, exactly what we would see in the T accounts. Then notice the third set of columns there are my adjusted trial balance. Once again, I'm going to check and make sure that my numbers are, debits and credits are equal. Debits and credits, even for my adjustments, are equal. And then what I will do is I'll take all those numbers at the bottom and prepare my income statement. Okay, and that'll tell me the income statement. The difference right there that I need to make them equal is my net income. Okay, and then I do the same thing with my balance sheet over here. Okay, there's my debits and credits. Two quick notes, that 14 grand there will not show up anywhere on the balance sheet. Okay, and the reason is because that 39,942 is not my retained earnings. It's 39,942 minus the 14 grand. So what's going to show up in retained earnings, and it's that number there, is not going to be zero, but it's going to be, the sum of those two, which is what, 25,942, which is what we saw in the balance sheet when we prepared it earlier. That concludes the lecture for Chapter 5. If you have any questions, as always, let me know. Thank you.